Mahesh Nandurkar, India strategist at CLSA. He's joining us on the show this morning. Mahesh, good morning to you, and it's great to have you here. I just want to first, comment on, CLSA's outlook on the Indian equities, which probably pegged the Indian markets and the Nifty target somewhere closer to 11,000, 11,500. We're right there currently. Does the current excitement and the money that has been coming in, the liquidity that's there in the market, change that outlook for the rest of the year?
Yes, a lot has been driven by the investor sentiments, and what has happened over the last 3 months is two things. The global investor sentiment towards emerging market has improved significantly, and also the sentiment towards India has also improved significantly. So we did take cognizance of that, and we did change some portfolio allocations, and we did turn more optimistic on the markets about a month or a couple of months ago. But the thing is, we still believe that the valuations are in the higher territory. The market, the Nifty, still trades at about 18 times on a 1-year forward basis. Also, the data points from the from the bottom up basis at the broader economic level, or even from the individual companies level, doesn't appear to be all that great. So there's a bit of a mismatch between the investor sentiments and the bottom up economic data. But I guess what ultimately matters for the stock market performance in the near term is the investor sentiments. Those are clearly on the positive side, and we therefore expect the markets to continue to do well at least over the next few months.
Does it change your target on the index in any way?
Yes, so I would be looking at the index moving closer to sort of 12,000 or maybe a little bit beyond that over the next few months.
Okay. The other point being, now that we've got elections around the corner, a 21 global investor survey conducted suggested that it's not just about the result of the election now that matters, and whether or not the Modi government comes back into power with a majority or not. It's more about the focus and the agenda with regards to the economic pickup and the growth that needs to be focused on, bringing back jobs into the economy and a broader perspective as such. Would you say that all of what we've seen in the last 1 month is a precursor to the election results being baked in, and that could actually reverse if the results are not favorable?
Yes, I think the market is factoring in more stable government at this point in time. Clearly, the market is factoring a higher probability of that. I wouldn't, however, say that it's fully baked in as yet, because it's never done till the time it's done, as we have seen many a time in the last several election cycles that we've seen here in India, not just in India, elsewhere in the world as well. So I would say yes, now the market is building in maybe like a 70, 75%, 80% chances of a stable government, but not fully baked in as yet. But having said that, I would also say that the market rally that we've seen here in India is not attributable only to what's been happening within India or the political sentiments, etc. But a large part of the rally is also associated with what's been happening globally. I mean, you look at the Asian indices, or even the global the MSCI World Index. All of these indices have done very well over the last 4-5 months, up between 10% to 15%. So India is not the only market. So I would say a large part of the rally that we've seen is more due to the improvement in the sentiments of the global investors, due to global factors, like now we are building in a probability of a possibility of a rate cut, in the US. We're also talking about the European Bank, ECB also going very slow. We are also looking at a possibility of a resolution between the trade conflict between the US and China. So there are a variety of global factors which have also turned favorable. And yes, the improvement in the political sentiments here in India has also added to that.
Mahesh, good morning. Neeraj here. What do your large global clients tell you when it comes to putting money into India? I reckon March was more about ETFs coming in and not dedicated long-only funds coming in. What do they say? Are they comfortable putting in post-May if there is stability, even if the valuations are high, or are they skeptical and waiting for a bit of a pullback on values before they decide to put in money? What's the nature of those conversations?
Well, good morning, Neeraj. The feedback from the global investors continues to be that the primary concern on India is valuations. I mean, let's face it, as compared to an average P multiple of say around 15 times or so, we are about 20% higher than our historical averages. So that clearly is the source of worry, and many good businesses which the investors want to own are trading at a very high level of P multiples, especially on the consumer side, the discretionary side, and the multiples are like 35 times, 40 times or upwards of that. So that remains primarily the concern. The second incremental concern is coming up on the back of the consumption slowdown. I mean, we have seen the numbers from the auto companies being weak, and there have been some commentary made by the consumer staple companies as well. So in that respect, what we see in the March quarter results and the management commentary, I think will play a big role in determining which way the growth is looking like, and the investors are quite and rightly focusing on that. On the positive side, obviously, if we get to see a stable government, there is that much more predictability on the FY20 earnings growth, and there's going to be continuity of policies. So yes, I mean, it's a mix, and my sense is that and just to repeat what I said before, while the market has factored into a great extent the possibility of a stable government, but there can still be some upside as we get closer to that event.
The other question, Mahesh, is if indeed the markets are expensive and your clients, or largely clients for a lot of other broking houses, might be worried about valuations, are they comfortable putting money into the side pockets? Because I mean, I remember your conversations with Devina at your conference, wherein you guys spoke about a lot of non-nifty themes which could do well. Real estate, for example, has done remarkably well. There is a bit of a recovery that's happened in some of the NBFC stocks as well, which had gotten beaten on alpha LFS. No nifty presence, but moving up. Can money come into the side pockets, even if the market doesn't move too much post-elections as well, because it stays overvalued?
No, that's true. There will be several bottom-up ideas. There are a few mid-cap companies which are also looking attractively valued. Some of these are on the EPC contracting side. Real estate, as you rightly mentioned, this is something that we've been very excited about. And we feel that the listed real estate companies are getting the twin benefit of one, the industry consolidation. So even if the broader housing market does not do well, the listed real estate companies can do exceedingly well. In fact, we are seeing that in the quarterly numbers and the pre-report that we've seen for the March quarter as well. And secondly, we are also quite optimistic that eventually, give another 6 months or so, the broader housing market will also stage a recovery. So real estate is one segment that we continue to stay very, very excited about. And yes, there will be some like similar other small mid-cap companies as well. But I guess that will be a more bottom-up call and more company specific.
Your recent report suggests that you need to start focusing on the interest rate sensitives and the interest rate regime now, where most of the central banks have given very dovish commentary, and we are on a declining trend and a declining path towards interest rates cuts. What happens then with regards to the financials here in India?
Well, we believe that the two straight back-to-back rate cuts that the RBI has done And if you look at the commentary, that still leaves more scope for more policy rate cuts going forward. We believe that the inflation outlook or the CPI number, let's say 12 months down the line, would still be hovering at about 4% or thereabouts. And our own analysis suggests that the food inflation is likely to remain at a lower level for structural reasons. Yes, there could be some seasonal and intermittent volatilities, but if you take a 1 year, 2 year view, the inflation should stay stable, and that would leave another 25 to even 50 basis point rate cut by the RBI in the near term, and maybe more as we go ahead. So that clearly, makes the case to own the interest rate sensitives here. I mean, we talked about property, as one of the key interest rate sensitive. Banks and financials is the other one. And there clearly, I would say that the kind of wholesale funded institutions would probably see more benefit of the falling interest rate environment. Obviously, the other big theme which has been unfolding in the financial space is the peaking out of the NPLs. We are very much on track of that, and my sense is the corporate banks, the private corporate banks, also a select state-owned corporate banks as well, should also continue to do well going forward.
All right. So, while when we talk to most market participants, it is the big theme, the broader theme that will lead the rally going forward is going to be financials. You also spoke about some side themes that are probably not big index names, but have done well and they're likely to do well. Anything else, Mahesh, aside from the financials, which could be the big theme driver? And if you differ from that, obviously, your comments most welcome on that as well. But what other themes are going to lead the run-up? Is it going to be a consumption theme? Is it going to be an investment theme? What's it going to look like?
Well, I would say that, if I take a slightly longer term view, say over the next 2 to 3 years, or thereabouts, what I clearly feel is that, there is likely to be a big change in the market sentiments, away from consumption theme and into investment theme. We have seen the consumption theme playing out very nicely over the period of last, more than 5 years now. And I think now, my sense is that the GFCF, the gross fixed capital formation in the country, has bottomed out. The investment cycle will begin to show some signs of improvement. And my sense is the investors should be gradually looking at making that shift, in the portfolio as well. So, I mean, we talked about financials, mostly on the corporate side. We've kind of talked about, property. In fact, property is going to be one of the biggest beneficiaries of this, investment cycle upturn. The others would be the select EPC contractor names. Cement is also going to be a theme that will do well. And, incrementally, as the households begin to kind of, save more and invest more, naturally there has to be, some, small level of moderation, on the consumption side. And so that's point number one. And point number two is, also on the P multiples. The P multiples on the consumption side are at an elevated level. And the primary reason for that has been the lack of opportunities in the other segments of the market, primarily on the investment side. But as that part of the economy and that part of the market begins to do well, I would say money will also begin to slowly shift or reallocate more towards the investment themes that we just discussed. And so to that extent, over a medium term, let's say 2 to 3 year perspective, we see the probability or the chances that the consumption theme might underperform.
Would the underperformance be a factor of a time correction, Mahesh, or could it also be that the volume growth numbers which have been cranking up all through the last 3, 4, 5 years might come off as well?
Well, maybe a combination of both. Maybe it just happens by way of time correction. That's also quite possible. That if you are looking at the earnings growth for the broader market to be in the range of 15 to 20% of the next couple of years, and on the back of that, the market continues to move up. Some of the expensive consumer names might just stagnate and might undergo a time correction. But my sense is that if you take a 2-year view, there's likelihood of that theme underperforming.
Other big subset of this wide consumption theme is autos, which has probably already seen the first signs of that slowdown. Now, my only question is, do you attribute this only to the NBFC stress as being the lead indicator? Because I was speaking to an industrialist who told me that if you look at the two-wheeler space, except Honda, from a Bajaj to a Hero to a TVS, have their captive financing arms. Therefore, financing was probably not the reason why the slowdown happened in the first place. It could well have been higher, or petrol prices or something else. What do you attribute this slowdown that we're seeing in the wide bucket, not just two-wheelers too? And when do you reckon it can turn around? Is it too soon to even talk about a turnaround?
My sense is it is too soon in my view, because as you rightly mentioned, it's not just two-wheelers. We are seeing the auto sector numbers slowing down across two-wheelers, four-wheelers, tractors, commercial vehicles, and we have seen some of the consumer staple companies have also talked about some slowdown in the consumption trend that they are witnessing. So my sense is that it's not only because of the NBFC related concerns, it's probably a combination of NBFC concerns plus the fact that the oil prices are high. Maybe there was some change in regulations which upfronted some of the insurance costs and therefore increased the upfront pricing of some of these two-wheelers. But I think we still cannot ignore the fact that there could be, we could be looking at some sort of a slowdown in the consumer purchasing behavior as well. And in that sense, as I mentioned, the March quarter corporate result season and the management commentary will be quite critical because that will give us a good idea on whether the slowdown that we are seeing is only limited to the autos, or is it more widespread and visible in the other consumer categories as well.
All right. That's for the auto space. But Mahesh, just one final question. When you're talking about a target of 12,000, are you looking at a particular rate of earnings growth for the Indian equities? What would that number look like? Will it be, the early double digits? Would you look at a number closer to 15 to 18 odd %?
We would be looking at a number close to 15 to 18%, closer to 20%. And one of the primary reasons for that is going to be a big swing that we will see in the banking and the financial sector profitability. You would remember that FY18 and also 19 to an extent has been quite a bad year for these corporate banks and financials with large amount of provisioning costs coming through. Now, a lot of that will not be there for FY20, and the YOY comparison will be very easy. And we expect the banks and financial segment to report very strong numbers in FY20. In fact, we will see strong numbers starting March quarter of 2019 itself. But on an overall basis, we are not really seeing any big pickup as such. If you exclude the banking and financial space, and if you exclude some of the companies which have some low base effect and some exceptionals, for broader market, I would say that I can hear you.
Yeah, Mahesh. Maybe there's some unwanted interruption. Please finish your point.
Yeah, so the point I was trying to make was, except for banks, financials, and also some of the companies with low base effect, etc. For a broader market, the earnings trend will remain similar. But yeah, for on a reported basis for the overall market, the earnings growth should be in the range of 15-18%, driven by the bank's financials.